So, gold's been on an absolutely wild ride, right? After this incredible rally, the floor just fell out. And now the big question on everybody's mind is, what's next? Are we looking at a total crash, or is this just a pit stop before the next big move up? All right, let's get into it and see what the clues are telling us.
Okay, first things first, let's just take stock of the damage here. We're talking about a massive 5.6% plunge in gold futures. And it happened fast. This wasn't some gentle little dip. Nope, this was a sharp, aggressive sell-off that really caught a lot of folks off guard. The bulls, they were immediately on the back foot.
And that brings us right to the heart of the mystery. Everyone is now staring at this one critical price level, $4,800. Now, if you're a bear, that's your next target. You're thinking, we're going down. But if you're a bull, you might be seeing the perfect buying opportunity, a real springboard. So, which one is it? Let's start digging into the evidence, and we'll begin with the case for the bears.
So the main argument coming from the bear camp is pretty simple. They're saying that recent rally, that wasn't real strength. Not at all. They believe it was something way more sinister, especially for the buyers. A classic pattern called a dead cat bounce.
So what in the world is a dead cat bounce? Well, it's a classic trap, really. The name is a little grim, I'll admit, but the concept is super straightforward. The saying goes, even a dead cat will bounce if it falls from high enough. And in the market, that means you get this brief, totally deceptive rally that sucks in all the optimistic buyers, right before the price just collapses again to even lower lows.
And look, this isn't just us talking with 20/20 hindsight. An analyst, Matt Simpson, he actually flagged this exact risk before it happened, right near the peak. He pointed out that the way gold was rallying just felt kind of weak, grinding, unsustainable. And man, his warning turned out to be spot on. The market turned south almost immediately after he said it.
The technical charts seem to back this up too. If you look at the charts from that time, you see these things called bearish engulfing candles pop up. And in the world of technical analysis, that is a huge red flag. It's kind of like watching a heavyweight boxer just completely knock out a challenger in the ring. It's a sign that the sellers have just taken total control from the buyers. And where are they aiming next? All signs point to that $4,800 level we keep talking about.
So the case seems pretty open and shut, right? You've got these bearish patterns, a prediction that came true, case closed? Well, hold on, not so fast. Because when you start to dig just a little bit deeper, the whole story gets a lot more complicated. Let's look at our first major clue.
Yeah, to really get the full picture, you've got to follow the big money. And one of the best ways to do that is with something called the Commitment of Traders Report, or the COT report. Think of it like getting a secret peek at the poker hands of the biggest players in the game.
And what is that report telling us? Well, have a look. The big players, we're talking large speculators, managed funds, the smart money, they've been upping their short bets. In plain English, that means they're betting more and more that the price of gold is going to go down. In fact, for the large specs, their net long position is at a one-year low. So yeah, that definitely feels pretty bearish.
But, and this is a really important but, there's a nuance here. The analyst points out that while the trend is definitely leaning bearish, these short positions aren't at some crazy extreme level just yet. We're not seeing all-out panic from the sellers. It's more of a warning sign for the bulls for sure, but it's not necessarily a death sentence for the rally.
Okay, now we get to our second clue. And this, my friends, is where the plot really starts to thicken. We're going to take a look at the options market. Why? Because it can tell us a ton about the collective emotion of all the traders out there. It helps us answer one key question. Is the market being driven by greed, or is it being driven by fear?
The key metric we're looking at is called option skew. I know, it sounds a little complicated, but the idea is actually pretty simple. Just think of it like this. It measures how much traders are willing to pay for price drop insurance compared to how much they're willing to pay for price rise lottery tickets.
And this breaks it down perfectly. The puts, that's your insurance. Those are bets that the price is going to fall. So when demand for puts is high, it's a huge sign of fear. On the other side, you have calls. Those are your lottery tickets. They're bets that the price is going to rise. And when demand for those is high, it signals greed. So by comparing the two, we get this amazing real-time read on how the market is actually feeling.
So what's the verdict? How is the market feeling right now? Well, in a word, fearful. Overwhelmingly so. Just look at this chart. There is a massive skew towards puts. Traders are literally rushing to buy that price drop insurance, paying huge premiums for it, while at the same time showing almost zero interest in those upside lottery tickets.
And we can actually put a number on this.
There's a metric called the 1-week risk reversal, and it has just plunged to its most negative level in over a year. So let me be clear, this isn't just a little bit of nervousness we're talking about. This is a sign of extreme, off-the-charts pessimism and fear. But here comes the twist.
And this is where things get really fascinating. The last time fear was this high, the last time this metric was this negative, guess what happened next? Gold prices rallied. Hard. It suggests that maybe, just maybe, the fear has become too extreme. You know how it is when everyone is betting on one thing happening? The market has this funny habit of doing the exact opposite. So this extreme fear, it might actually be a contrarian buy signal.
So, where does all this conflicting evidence leave us? It's a bit of a puzzle, right? On one hand, you've got these clear bearish price patterns screaming sell. But on the other hand, you have this extreme level of fear that historically has screamed buy. It's a classic standoff.
Let's just lay it all out, right? The stalemate. In the bear corner, you've got that huge 5.6% drop, those nasty-looking chart patterns, and of course, the big money increasing their short bets. But in the bull corner, they've got a pretty strong defense. The sell-off hasn't really gone anywhere. That extreme fear is a classic contrarian buy signal, and everyone is watching that $4,800 support level like a hawk.
So, with this kind of deadlock, the analyst's conclusion isn't some dramatic call for a crash or a massive rally. Nope. Instead, the most likely outcome is just a messy, choppy battle. It feels like neither side really has a clear enough advantage right now to deliver that knockout blow. And this fight is probably going to happen within a very specific price range. The key zone to watch is between $4,800 on the low end, that's where the bulls are going to make their stand, and around $5,100 on the high end, that's where the bears will likely show up again. So you can probably expect the price to just get bounced around between those two levels for a while. So, the stage is set. You've got a market that's being pushed down by some pretty clear technical signals, but at the same time, it's gripped by a level of fear so extreme it often means a bottom is near. The bulls and the bears are dug in, ready for a high-stakes showdown. Really, the only question left is, who's going to flinch first?